last week when we were having your prep call, you mentioned, oh, this FBI thing is really heating up. And then the next day the story broke, and I was sort of curious how you knew, were the FBI knocking at your door, or
well, actually,
were you wearing a wire, perhaps?
Actually, no.
Is that wire?
Yeah. No, the story broke actually here in the UK first, even though it was a US story. But it's been, I've worked in both the US and Europe, and the practices and the way media has been bought and compensated for is different. And, it has been a really big issue in the US over the last probably 8 years or 10 years with a lot of undisclosed practices, many of which were under non-disclosure agreements that were being hidden and had created a real problem in the market. The Association of National Advertisers in the US, which represents the brands, put together an investigation. Many of the people interviewed were actually working within agencies, and I think felt very uncomfortable to where they were stuck because probably in most cases, the brands are not paying well for their services. They got to find a way to make money, and it created a pretty ugly system. And the other shoe dropped, which people wondered if it would, which is that was this just unethical business practices, undisclosed business practices, or are there illegal business practices? And it seems pretty clear that there are a number of them in the US that were illegal.
And in terms of your business, are you working mostly, with Takara talking about the role of agencies and brands, are you mostly brand-facing or agency-focusing?
The vast majority of our business is client-directed, meaning that when we are running a campaign for the Home Depot, a home improvement retailer, all of the instructions are coming from Atlanta and corporate from the Home Depot, but the invoicing is through their agency, Cara, or Cara as they call themselves in the US. So I think probably 50% of our business actually is transacted through an agency, but 85% is client-directed. Mostly because we use a lot of first-party data. We get into a lot of deep attribution, and in the TV marketplace in the United States, in the linear TV marketplace, agencies aren't really that comfortable having part of the buy separated out and seen and accounted for to specific transaction data. So it's a triangular relationship.
And we often hear that programmatic TV and addressable TV is progressing a little bit more quickly in the States. I'm not sure, some people from Sky would dispute that.
I would dispute that.
You would dispute that?
Yeah. In my first business, Real Media, we had an addressable TV group here in 1998 and 1999, and I still have the deck where we represented 4.3 million households across the UK and Europe. We were partnering with NTL, Telewest, Cable and Wireless, France Telecom, Swisscom. So no matter what numbers you see, it's hard to get 4.4 million households in the US today in an addressable footprint in a campaign. I think that the infrastructure and the focus actually went faster in Europe. There is finally a movement in the US, but I would say without question, the technology in Europe for the delivery of the addressable ad inside the linear footprint is superior to the technology that's used in the United States today. The only way, I could get into the technical part, but basically to get an addressable ad in the United States today, you have to have a DVR. That ad has to be queued up. The decision is actually made on the pod position way in advance. And if the person doesn't actually turn their TV on at that time, then that ad can't be delivered. So addressable campaigns in the US have to be delivered over a month or more. My understanding of AdSmart, for example, is there's much more intelligence at the box level itself, so it can actually make a decision relative to when the person actually views. I think in the Comcast X1 box, we'll see the same thing, so I think it's interesting to see Comcast and Sky coming together. But I can imagine Comcast, leaning heavily on the people here for how they may be taking some of that approach back to the US.
Speaking of people coming together, one of the things we spoke about yesterday with Dags was the way in which broadcasters across Europe have been working together, and they've sort of finding common cause in sort of taking on the tech giants. Similar moves have been taking place in the US, of course. You've got OpenAP, which is sort of a joint initiative. You guys have your own marketplace. AT&T are going to be launching one with Nexus. I think that's next year, 2019, I think. Or
They said, Randall Stevenson, the CEO, said 12 to 18 months, but I think the folks on the ground may find it takes a little longer to do some of those pieces, but we'll see.
So I mean, you're sort of one of the sort of characteristics of the US market is the focus on these upfronts. The upfronts get a lot of coverage, they're quite big events. And first of all, could you explain to some of the people in the room might not be familiar with what the upfronts are? But also, you know, how do you dislodge that model in order for things to be traded programmatically, if they need to be dislodged?
Yeah, I don't know that the upfront needs to be dislodged or will be dislodged, and it certainly is not an impediment or a barrier to advanced TV advertising. One of the biggest differences in the linear TV ad market in the United States that's incredibly different than the digital ad market in the US, and I think in most places in the world, demand exceeds supply. I mean, simply put, there is more money that wants to buy TV advertising in the pricing and packaging as it's delivered today than there is supply. And so, like anything else, if you have something that's viewed as precious and it is scarce, you have an auction for it, a futures market. And so you have a very significant futures market. It happens once a year. That way the sellers don't actually have to go to people's offices and call on them or take them out. They make everybody come into an auditorium like this. You have to sit next to your competitor. You show programming that may or may not actually be available or on or may, you know, in 6 months, and you do a bull rush and they have to buy it. And if they don't buy it, then you tell them that you're going to charge them 30% more later in the market. One of the reasons they do that is, in some ways, there's actually the pricing is artificially low relative to what we think of in premium video and digital. But in the digital world, there's a lot more supply than there is demand. So we have to build systems with real-time decisioning and waterfalls to say, who will take this at the last moment? And so I think what's going to continue to happen is the TV companies will continue to be really smart at marketing their new shows and their products, and live sports particularly, as something that is special and scarce and should be bought not just for rational reasons, and there's lots of good rational reasons, lots of reach, big impact, sight, sound, and motion is powerful, but also for irrational reasons, which is you want to be part of this show, it's got your brand context all over it, and they'll continue to do that. However, the TV companies will back that up with more secondary data about how well those spots did by tracking the data from who watched the ads to who made purchases. And then the rest of TV's inventory, all of this stuff that is fragmented, but I would even change the one thing on the slide from the last presentation and say atomized. 80% of all TV ad inventory in the US today is on an episode of a show with a rating under a 0.5. Meaning less than 0.5% of the TV households are watching it. 10 years ago, it was reverse. 80% was over. And so I think that we are going to see a lot of data come in. I think that TV is going to, there's continue to be more demand, which means that the upfront's not going away.
Mm. And does this have an impact on measurement? I mean, as we get towards, you know, more data-driven environments, is the way we...
Yes.
Yes.
Yeah. Today, the Nielsen panel is about 30-some thousand households in the US. It is a very well-managed, accurate panel for some sort of socio-demographic way to project what people do, but it does not have enough granularity to deal with those 80% of the inventory units. And so it's been making a lot of steps, certainly too slow for most in the market. I think that it's good at the top of the funnel metrics, like generally who was watching and how much reach was delivered. It's been breaking in areas like that, but it does not, you know, Nielsen's been slow to go down the funnel. I think they recognize, like, actually understand who watched something and did they purchase, and that's going to be a big part of the future of TV advertising in the US.
Another thing, again, this is a recurring theme of the conference, but the consolidation in TV is something that I think you can't avoid talking about in any session. Do you think that these moves to consolidate the TV industry, is it going to be enough in order for them to survive against the Googles, Facebooks, Amazons?
I don't know. It depends on why they're consolidating, and I'll go through some of the deals. most of the people that have owned linear TV companies in the US today actually don't believe a lot in linear TV because they were selling them. Companies that own distribution, like AT&T and Comcast, believe in TV, which is why they're buying them. So the distribution companies believe that owning content to put in their pipes for higher value makes sense. Some of the companies that had fixed broadcast, license-driven distribution believed in them less. Disney is taking a really long and hard bet on just going direct to consumer and sort of not worrying about the distribution. So I think we're going to continue to see more consolidation. I think that these new companies are recognizing that whether it's AT&T, whether it's Comcast, that advertising and data-driven advertising, technically managed delivered advertising is going to be an enormous part of the value of their business. I was in an event last week that AT&T hosted, and Randall Stevenson, the CEO, was there for most of it, just talking about advertising, and that was the primary synergy driver in an $86 billion transaction.
And as part of this consolidation, we're also seeing it's not just telcos and broadcasters. Ad tech is becoming part of the mix.
Yes.
Yeah. Is there, as time goes on, I can remember, for example, with Comcast buying Sky, or buying Freewheel, and now they've become part of Sky. I can remember not too long ago where people a lot of the broadcasters would be quite nervous about their relationship with Sky, for example. They were the sort of platform. Yeah. And now all of a sudden, these companies are sort of merging and offering them their ad tech. Is there still a role for an independent, what AppNexus used to be, like an independent ad tech provider?
I think so. I think that people's resistance to using technology of a dominant market player is something we talk about a lot, but it's not happened in practice. DoubleClick, Dart for publisher, Dart for advertiser, in spite of being owned by Google, is still the most used ad server in the world. And in spite of having a particular fondness in my heart for Open Ad Stream, OAS, but now owned by AppNexus, now owned by AT&T. So I think there is an opportunity for an independent. I think that we haven't seen companies that have built real scale there. If you take the Lumascape that Terry Kawaja, the banker, puts together, and you put all those ad tech companies on it, and you also have a place where supply exceeds demand, if you take all the gross margin that those companies make, let alone net profit, you'll find that it's certainly, very few are net profitable. There's a limited amount of true net profit that goes through them, and there's a lot of throughput and a lot of gross margin, gross revenue that is not creating real value. So we'll see a consolidation in that space. I do think that there's opportunity for independent. We've just become 10 years old, like this week, 10th year anniversary. So I do believe in independence.
If that was an American audience, everybody would go, woo, yeah, yeah. Brits, 10 years, that's good. Yeah.
Yeah. Well, in the online world, I've been 23 years in digital startups, so 10 years is a long time.
Yeah. Congratulations. Let's do an applause. Yeah. Do an applause. Come on. So yeah, I'm part of a Slack group, and it's various industry people, and one of the most recurring topics that we talk about is the valuations of the different the ad tech companies who've gone public. It's been sort of fascinating, and again,
it's been bad.
I think
it's been bad. I've been part of this market since the 90s when we had the round tripping in the early ad tech companies, and at one point DoubleClick was valued at $12 billion, and 24/7 was $8 billion, and Engage was $9 billion. You can move money quickly, and you can count the same dollar or pound or euro 10 times in a transaction. So 10 different companies can capture it as gross revenue, and that creates a real problem for the stock markets and the city or Wall Street to value companies. And so what we have found is that a lot of companies, particularly those that got really close to agencies, could in a period of time have massive amounts of growth in gross revenue, could have pretty good margins until someone wanted to start taking that margin out, until it got squeezed, and we've seen these companies go up, and then we've seen them come down. And I think of the last 10 or 12 ad tech companies that have gone public in the US, think we've only got one of them with a enterprise value over $100 million, and every single one of them, traded at some point for $500 million, $1 billion, or multiple billions.
Let's name names. This is it'd be more fun if we can talk about who we're talking about. Trade Desk are obviously they're the rising star.
Yeah, that's the darling of the moment. I think Trade Desk has actually, in some ways, been as a next generation version, has been a little bit more explicit. Where I think the Tremors and the Yumis or Rocket Fuels or some of the ones we saw before were a little more vague about, hey, we just add value. They've said, no, we have real close relationships with agencies. This is what we do. We're going to see a certain amount of margin compression. They're obviously on a tear right now. I think the market cap's got to be $7 billion, 6.5 or 7 billion.
6.5, I think, yeah.
I think the big issues are, the street is trading them up for a couple reasons. One, CTV, Connected TV, that's the latest acronym. I don't know, it's PTV, programmatic, and LTV, whatever, and international growth. And they've held their margins pretty well. My bet is because they're so software-based, the one thing I look at when I look at these companies, I look at sort of engineering team size relative to the total employee headcount. Most of the companies that said they were tech were just offshoring to Ukraine. I mean, it's offshoring for us. It's not quite offshore here.
Yep.
Well, I guess it is offshore here, but not offshore for Europeans. So to the extent they can keep solving it with software, they'll hold it up longer. To the extent they can drive more international growth, they'll hold it up. The CTV, Connected TV, is really tiny. They probably can't keep tracking that. If they can hold on to that and probably find a path into linear TV, then I think they can make it to the other side. But we haven't always seen companies that look like them make it to the other side.
Again, yesterday with my chat with Dags, he sort of mentioned, I asked him if he could eliminate and murder the employees of any one company, who would you choose? And he chose Amazon. Would you, he used to be in the army, so it was a reference to his army background. I like Amazon people. Yeah.
I think Amazon...
Amazon, should we murder them all, is what I'm trying to ask.
Well, I'll tell you, I think Amazon is extraordinary. I think that I've watched that company and I've watched them for well over 20 years. I've had friends, I actually had a friend who just retired after 21 years there. I think that the way they're executing is really extraordinary. I think that the fact that let's look at video advertising. The fact that they can come into video and video advertising differently than anybody else. I mean, in the panel right before, it was talked about how some companies like a Facebook or even an Apple throws token money to independent producers to get product. That's not what's going on at Amazon. They want to build the first ground-up studio that's been built in the last 90 years. And they're taking that strategy. And if you look at what's being done in Prime and Originals, and then if you look at Twitch, which was bought into the group that owned Personal Storage, and they just saw an opportunity. That was not part of this sort of like cohesive strategy to attack video. It was, hey, this fits our business well. They buy it. Then they realize Twitch could be a bigger ad-supported thing, and they give that group the power. Then you have the hardware people that do the Fire TV that realize, hey, why shouldn't we be able to build our own independent streaming services with TV companies? They don't have to go ask permission to Prime to go do that. They can go do that on their own. And then you have people in the AWS group are saying, why shouldn't we have a video ad server on top of it to serve some of these things? Because that's a high margin bits business that we should do. All four of those things are going to fundamentally could converge, but they're ultimately going to have the same impact, which is they're going to roll in this business. And the most important thing compared to the rest of FANG, and I know we're out of time, is that money that when a dollar goes into the Amazon business, you don't have 83 cents going into Mark Zuckerberg's pocket and the pocket of his investors or Google that are coming out all in net profit. Outside of AWS, everything's losing money. All of that money is going back to the consumer. Now Walmart did this model, and you can argue at some point it has to change. But for now, all of the money going into Amazon is subsidizing other things that are fundamentally more products at lower prices, faster than people have ever had before. More video content, faster, cheaper.
Okay.
But I'm scared of that. I'm in awe of them, but I'm scared of them.
I think everybody is. Okay, you have a habit of sort of starting companies that sell for hundreds of millions. What is there any? You know, we've seen fewer and fewer ad tech startups springing up. Are there any interesting opportunities left, do you think? And if you had to choose something aside from your own business, of course, what would it be and why?
Well, yeah, I think there's a lot of opportunities left. I think the problem with ad tech is when it gets frothy, everybody wants to start ad tech, and then when it's not frothy, they all want to get out of it, and they didn't know what they were trying to do. I think that there are a lot of issues to be solved in integrating truly cross-platform and what that means. I've not seen people come at the market from a consumer standpoint. I continue to see people come at the market from a trade standpoint and solving a problem for an agency or a problem for a publisher or a network or a seller. They're not solving it from a consumer standpoint. I think we're going to see real innovation there. I think the whole direct-to-consumer movement, or D2C, as it's being called sometimes, the fact that the large brands that were big packagers and use distribution are going upside down, I think those companies are going to have very different advertising and marketing approaches. These are the Dollar Shave Clubs, as we saw earlier. You know, the new ones now are Quip toothbrushes and Casper mattresses, and these are just the US versions, and Mack Weldon underwear and Away luggage. I think those businesses are going to, I think Procter & Gamble is not going to be relevant to anybody in 5 years. It's not going to be relevant. And I think that is going to bring a whole new need in ad tech, marketing tech that we haven't seen. In the pure marketing tech, you see business like Shopify that's just off the charts growing. We're going to see a lot of that in the next generation of marketing tech.